Exchange traded funds, or ETFs, can provide easy access to a wide range of markets and asset classes. But with this ease, investors can sometimes fail to avoid common mistakes. In this episode, Chad Wood from Mackenzie Investments identifies top mistakes ETF investors make and provides some tips on how to avoid them. You're watching Inside Investing. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Jason Nadek. Joining us here today is Chad Wood. He's an ETF strategist who also educates advisors as well as clients on enhancing their ETF strategies. Chad, it's great to have you with us here today.
Thank you, Jason. Really happy to be back.
It's a pleasure to have you back here on the program. So maybe you can give the audience a little bit of background here, Chad. What brought you into the ETF world?
Yeah, and again, thanks for having me. And when I say to be back, I really mean it because I was at TD for 10 years and now I'm at Mackenzie Investments. And that's what really got me in the ETF space. I was at TD, like I said, for 10 years. I had a lot of different roles, credit cards, mortgages, and then I was a broker at TD Ameritrade. And that was my first really stint in new investing. And then moved over to the asset management side, started working with ETFs as, TD Asset Management started launching new ETFs. All these firms started to get into the game because ETFs just started really blowing up in Canada, and as they should, because they are a great innovative product. And yeah, from there, the rest is history. I've been in ETFs for about 5 years now and not looking back. And I love educating clients and advisors and talking all things ETFs.
You've got a lot of history that spans like kind of the gamut of much of financial industry. So really, I think our audience has got a great guest here to learn a lot from. So when we talk about your role as an ETF strategy, kind of what's that all about?
Yeah, and it's really my job right now at Mackenzie as an ETF strategist is really, I cover the whole country. So I get to travel the whole country. Like 2 weeks ago, I was in St. John's, and then the week after that, I was in Victoria. So I got to see both oceans. So it's a really cool job, first of all. But second of all, I get to just travel and meet advisors. I meet clients. I hear, how are they using ETFs? Why are they using ETFs? And how can I help, any misunderstandings they have, any myths they might be thinking, or how to strategize using them and putting them in their portfolios for, long-term investing, short-term investing, whatever it may be.
It sounds very interesting. And a little plus to you is you're probably racking up lots of frequent flyer miles for maybe use a little bit later. So that's a nice little perk. All right. Now, just a quick note to our viewers. You can subscribe to our YouTube channel. It's Inside Investing, so you don't miss an episode. And make sure to let us know what you think about today's episode and what else you'd like us to cover later on in the show. All right, now let's get into it here. Now, Chad, what makes ETFs so popular amongst investors today?
There's the obvious one is cost. A lot of the times, ETFs, just compared to, say, a mutual fund, it is quite a bit cheaper sometimes, and it gives you access to, say, beta or market strategies or indexing strategies that do come at a low cost. But and it's not only the cost that I think investors really gravitated towards ETFs. It's also the instant diversification. So one investment, one ETF can have 500 names. It can have 2,000 names. It can have 5. So there's so many, and that kind of leads me to the third point, I guess, which is choice. Like there's so many choices. There's over 1,400, I think now in Canada alone. And there's literally an ETF for anything. So there used to be a saying, when iPhones came around, like there's an app for that. Like really there is an ETF for that.
All right, so let's get down to the topic of the hour here. Let's get into some of those common mistakes that you see in the ETF world. What would be kind of one of the ones at the top of your list?
Yeah, and one of the ones, like a lot of these are easy and very simple to go through and avoid. I would say the first one is, what type of order are you using to buy your ETFs? And for those listeners on the call, maybe they've used stocks in the past, maybe they've used mutual funds, or maybe they already have used ETFs a lot. But an ETF is basically a mutual fund that trades like a stock, right? So when we're talking about trading, if you know how to trade a stock, then you know how to trade an ETF. There's just something to maybe keep in mind when you're investing on TD Direct Investing. You might have the screen that looks like this. And you can see bid and ask price, right? So what are those? So bid price is what's the highest bid. So somebody's trying to buy this thing. And you can see $218.32 in this example. And the ask price is how much are people asking? So they're selling, and how much will it take for them to sell it to you? and that's $218.50. And then after that, you have the lot. So what's a lot? That's just how many are available. A one lot equals 100 shares. So right now there's 1,400 shares available for sale, and there's 1,400 people are trying to buy right now. If you put a market order in, basically what's going to happen is you're basically telling the market, I want these shares as fast as possible at whatever price is available right now. But as you can see, you only know there's 1,400 available. So basically, you're taking the risk of maybe paying a little bit more than you wanted to. You just don't know what the next available price is. For ease of explaining a complicated thing, you can see here the ETF is trading at 20.05. That's the fair price of the ETF. And that's what we saw on the previous screen. When you saw that bid and ask, they're just showing you the best bid and the best ask. And that's all you really get to see. What happens when you have a market order, let's say, Oksana comes in, she's looking to buy 10,000 shares and she puts a market order in. So only 100 shares available, right? Great, she gets it. And then 200 shares are next, she gets those. Another 100 shares at 2012. And then there's 10,000 shares available at 2103. So she'll get all those, 9,600 of them. So now she's filled. But her average price was $20.99 when she thought, and at the beginning, it was 2006. So you can see here, this is like a way that a market order can, cost you a lot of money. That's where a limit order can come in. And limit order is really, you're setting a max price that you're willing to, purchase these shares at. And then you can see it get filled. So it's just an extra step. You do have to monitor it, obviously, to make sure it gets filled. So that is, definitely something I would say is always use a limit order over a market order when buying ETFs, just to make sure you know what you're paying for and you kind of maximize the amount. But it's definitely something that we see a mistake quite a bit is using a market order and maybe overpaying for something that you didn't have to overpay for.
All right, let's pivot to the next kind of common mistake. And this to me highlights the benefits of ETFs versus mutual funds is that you have the opportunity to trade kind of in and out of them on an intraday basis. But the risk to the investor is the kind of the spread, the buying and selling. There's potential for cost and risk. Maybe take us on a walk through that concept.
Yeah, absolutely. And I guess, and maybe I didn't mention this before, but what is the spread, right? It's just the difference between the bid and the ask. So the difference between what are people willing to buy this thing for and what are people willing to sell this thing for, the difference between those two numbers is the spread. So like you said, mutual funds, you don't have to deal with this. You basically just ask to buy the mutual fund. At the end of the day, they give you the units. For an ETF, the trading is on you, it can be an advantage because then now you're in control of that. So when we're calculating spread, we have two examples here. Say you have ETF A and it has a 2-cent spread, but the price is like the ask is 15.06 and the bid is 15.04. So you have 2 cents. Or you have ETF B, which is say $105.08 ask and a bid of say 104.98. So 10 cents. So I'll ask you, Jason, which ETF there in that example do you think has the better spread? So ETF B was 10 cents with a bigger NAV, ETF A was 2 cents with smaller NAV.
The lower the spread, probably the more efficient the ETF's trading and better for the trader to get in and out would be my first thought.
Yeah, and that is what a lot of people's first thoughts are. And this is why we bring it up because it's intuitive, the lower price, the better. But you always have to look at it as a percentage basis, right? So ETF A was actually more expensive than ETF B. And it's because when you look at it on a percentage basis, so 2 cents compared to $15 is actually much bigger than 10 cents compared to $100. So it's actually 29% less expensive to trade ETFB. So this is just something, again, it's a very simple mistake and it might not matter to absolutely every trade, but if you are trading large volumes or if you are comparing two ETFs that are identical, this can be very important to you to make sure that you're getting the best price for your trade.
And that's part of the benefit of being part of this program. I get to learn along with everybody else. So that's checking my box for sure. I felt like I was being set up there, but I'm okay I'm fair game for that as well. So that's great. Let's shift the focus to talk a little bit around tax implications and understanding that for those out there in the audience, consulting your tax professional is always going to be kind of the default answer when we're talking about taxes. But let's kind of talk about this in kind of broader overarching themes here. But investors can sometimes fail to understand, tax implications of their investments, and how can that be true with ETFs?
Yeah, and there's a lot of different tax implications when anytime you're investing, and obviously always seek tax advice if you do have any tax related questions. But there is one in the ETF world that we do like to focus on, and that is withholding taxes. So what am I talking about when I say withholding taxes? Well, most investors are probably familiar if they've ever bought a U.S. stock that pays a dividend and it's in a taxable account, so not in an RSP. Then there might be a withholding of say 15%. So if you get a dollar dividend from a US stock, there's a good chance that you're only getting 85 cents of that because there's a 15 withholding tax implied by the US before it actually gets to you. So with that in mind, this is actually very important for ETFs. And I have an example I'd like to go through. And the reason why it's so important is this foreign withholding tax. It often goes unnoticed because you don't get the dollar and then see the 15 cents leave. You just get the 85 cents. So you didn't see it leave. You might not notice it. I want to go through an example of where you're trying to buy foreign exposure. So you're trying to get international equity, and you're doing this in a taxable account. And there's three ways to do that. One, you can buy a US listed ETF. So that's like an ETF that trades in the New York Stock Exchange or the NASDAQ. Basically, it's built and sold in the United States. But as a Canadian, we have access to these markets. Two, a Canadian listed ETF, so made in Canada, trades on the TSX or a Canadian exchange, and it has one holding. It might have multiple, but one main holding is a US listed ETF. So basically, the second way just buys the first way, buys a US listed. The third way is just buying, a Canadian made, Canadian listed product. And all it does, it trades in, TSX and buys the international stocks directly. So let's go through what happens with your dividend through every one of these different structures of buying. So if you're buying US listed, let's say you get a $5 dividend. Well, those foreign countries are going to charge you, say, the 15%. We'll use 15% as the proxy just because that's what we're used to with the States. So that's 75 cents of your $5. Now you're left with $4.25. But since now you own a US foreign investment, US is now going to take their 15%. So you got taxed twice. So from your original five, you lost 75 cents and then you lost another 65 cents. You're left with $3.60. Okay, so that's option number one. Not ideal. Maybe there's a better option. Let's go to number two. Same thing happens. And it's because basically it is the exact same thing as number one. You get the foreign taxes, you can't really avoid that. However, since that Canadian ETF owns a US ETF, that same thing is happening. There's that foreign withholding tax between those two. So the US is still involved and they want their share. So again, you're left with 360. And that's where we get into the better option to avoid double taxation is a Canadian listed ETF that's investing directly in those international stocks. And you only have the one foreign withholding tax, and the U.S. is not involved. So there's no U.S. government to go in there and put their hand in the cookie jar. So you're left with $4.25. That's much more than 360. And then think about if you hold this for 10 years, this is compounding every year. So this is very important. So the example I just went through, that was one specific case. So do not memorize this stuff because it is confusing. Because if you're in an RSP and you're buying U.S. stocks that pay U.S. dividends, it's actually better to do number one and buy US listed. And that's another advantage of an ETF. You can take advantage of knowing this stuff, whereas a mutual fund, you couldn't do it as easily. So yeah, I definitely thank you for asking that question because this is one we see a lot, and it's no one's fault. It's just a unique problem we have as Canadians.
I can see this question coming up from the audience. So you've talked about how RSPs can maybe have a benefit of holding US stocks because they're not going to be subject to those additional taxes. What about TFSAs in your experience? How does that impact the taxation?
The rules for RSP and the tax tree between RSP, it's not always the same for a TFSA. So you never want to assume a TFSA is going to have the exact same rules as an RSP. So what I would recommend is always review and always ask the question of okay, what am I buying? So every situation is going to be, maybe slightly different. So yeah, my recommendation would be just know that TFSAs and RSPs don't always have the same rules, especially when we're talking about crossing the border and investing. So take a look at the resource, always ask, questions, and before you invest in maybe a foreign investment, just maybe always ask the question.
Now, Chad, I just had a quick question, a follow-up question around kind of the option number two that you presented there, the Canadian listed holdings that use US listed ETFs, kind of like a fund of fund type of thing. How do MERs stack up when we're thinking about those choices, when we're thinking fund to funds?
Sometimes the fund of fund just charges a single MER. And that at that point, it doesn't behave anything differently than just a standalone ETF. But some fund of funds will take a collection of the underlying costs and maybe charge an extra fee to do the management. So again, it's a good question to ask, and every fund's going to be different. Like we have ETFs that are fund of funds on our shelf, but they just have one fee. You don't need to worry about the fees underlying; those are all rebated back.
All right, next kind of common mistake we want to explore is geography. Now we've talked about how ETFs can give us access to these other markets, but there are any other kind of risks or misconceptions around kind of locations around the world that we're investing in that ETFs can be that we need to be wary of?
One thing as Canadians that is really amazing is that we are mostly like the US is the biggest stock market. So for the most part, a lot of the US stocks trade at the same time that our stock market is open. So that's a big advantage. However, if you're investing globally and say your investment has a lot of Europe in it, well, the European stock market, so our stock market is open 9:30 to 4 p.m., right? Eastern Standard Time. Now, the London Stock Exchange is open Eastern Standard Time, 3 a.m. to 11:30 a.m. So you can see there's a little bit of overlap. There's about 2 hours of overlap. So between 9:30 and 11:30 is the sweet spot. So why does that matter? So when you're buying an ETF, essentially you're buying an ETF and then someone's got to go buy the underlying securities, right, for you. That's the benefit of it. You buy one thing and then you get all these other things, all these other stocks. That's awesome. However, if those stock markets are closed, then we don't know how to price what we should, what's the value of those things. The stock market's closed. So what's the consequence of that? The spreads might be a little bigger. So the difference between the bid and the ask might be larger just to account for the unknown. We don't know what the stock market in London is going to open up tomorrow like. It also happens when, say, the US has a holiday, but we don't. You can buy US stocks through an ETF on a Canadian exchange. Same thing will happen. The spreads might just be a little wider to account for the uncertainty. So at the end of the day, you can still do it. But if you want to maybe give yourself the best outcome, it is usually best to, especially for European stocks, invest in those first 2 hours of the market open. For US, make sure they don't have a holiday or make sure their markets are open at the same time.
All right, so we talked a little bit about timing, right? The different times of the markets being open. Now, clearly, the different economies around the world work on different currencies. So, how do we address currency risks in ETFs?
Yeah, that's a good question. So a lot of firms, if it is US dollar, it'll be for the ticker. It'll usually have like a .u. And then hedged, usually there's like an H on the end of the ticker. But it's not always the same. So that's something to keep in mind too. Every company might do it slightly different. So the only way I think to know for sure is once you have an ETF picked out, go look it up on the firm's website. Read the description. It's usually at the top of the page. It'll tell you like hedge back to Canadian, or it'll tell you this is in US dollars. So I know it's a little bit more work to do this kind of research, but when there's so much choice, this also comes confusion, right? When you go to a buffet, you want to eat it all, but you can't. If you think Canadian dollar is going to go down, you think US dollar is going to go up, then yeah, there's an ETF that will help you play that view. But again, that's got to be what do you think is going to happen. The only thing I would say is over the long term, currency, especially in like United States and Canada, over the long term investing, having hedged or not hedged, typically kind of evens out. Like there's gonna be some years that going USD would have been great, and then some years going Canada would have been great. So over the long term, if you just didn't choose one, it's probably gonna make itself back to even.
All right, let's move on to the next kind of common mistake, and that's making selections based on yield alone. So, how can investors kind of safeguard themselves from that in the ETF landscape, Chad?
Yeah, and this is a good one. This is something that we see quite a bit, and we actually see this a lot in the direct investing channel, but we also see it a little bit in the advisor channel. But we definitely see it more with people managing their own money, and that's around yield. So I guess what is yield? So yield in this context is really like what is your ETF paying you as a dividend or a distribution? That's what we mean by yield. And yield, in terms of a mathematical equation, is the price of your ETF divided by, or sorry, the dividend that's paying you. So say it's $3 divided by 100. Say the price of the the ETF is 100. Well, that's a 3% dividend yield, right? So you're seeing a lot of ETFs now that pay, say, 10% dividend yield. You see 15, you see even up to like 20. And then ask yourself the question, how many stocks pay 10, 15%, 20% dividend yields, right? Not many. So how are they doing it? Because when you have a stock and it pays you a dividend, typically that's just a dividend from the company. They're just paying you, some profits. But when it's an ETF, it could be dividends. So it could be, Canadian eligible dividends that maybe have a tax credit, or maybe it's a dividend from a foreign country. So that very well could be part of your dividend. But what else could be part of your dividend is maybe interest. So say it's a fixed income ETF and it holds bonds. Well, maybe they're paying you a dividend, but in reality, it's made up of interest. It also could be return of capital, or ROC. If you hear people investing, people saying the word ROC, that typically means return of capital. And that's just basically them giving your own money back. So if they pay you, say, a $5 dividend, maybe some of that's dividends, but maybe some of that's your own money back. And then they're therefore no longer invested in the market. So that one's definitely one of the ones to keep an eye on, like especially if it's like, say, a 15% dividend. There's a chance they're giving you some of your own money back to make that percentage happen. And at the end of the day, it's not the worst thing. And if you're, retired and you need income, this might be an efficient way to get your income, is getting some of your money back in a systematic fashion. But again, it's getting taken out of the market and no longer invested. So, there's definitely goods and bads to each of these. Another one is capital gains. So maybe the funds actually made money, and instead of, you selling the ETF to get the capital gain, maybe they include it in your dividend. One thing, going back to the different types of yield and understanding where it comes from, it's important because I think that's going to determine your total return outcome. At the end of the day, if they're giving you a lot of your own money back, then your total return might be hurt, or maybe the yield comes from covered calls. So I do want to focus on covered calls a little bit.
All right, great. I'm interested to hear about the covered call ETF, like you teased us with there. So yeah, let's take take that step.
Cool. Yeah, and the reason why I talk about covered calls is there's been a massive boom, and you know what? Like billions of dollars have flown into these things in the last, I would say, 10 to 15 years. They're one of the most successful products in terms of direct investors, and I understand why. Basically, the promise of higher income, and people love dividends, people love income. And there's definitely a subgroup of investors, especially like retirees, that need to supplement their income through their investments. Covered calls are a great vehicle for that. And I guess before I get too far into the weeds, like what is a covered call? So simplistically, all it is you own a stock and then you write a call option on that same stock. And when you write a call option, essentially what you're doing is, again, let's use an example. Let's say the stock's $10. And you don't, when you buy a call, you are bullish. You think it's going to go up. So if you buy a call, you think the stock price is going to go up. When you sell a stock or sell a call option, essentially what you're saying is, I don't think the stock price is going to go that far up. So, I'll sell an option to someone, so they'll give me a premium. Somebody will buy that off of me, and then if the stock price goes up, I have to sell my shares that I have to them at whatever price we agreed on. So again, in that example, let's say $10 stock, you sell a call option at $11. They give you a little premium, so you make a little bit of income. And essentially, if that stock goes to, say, $15, you have to sell it to them for $11, even though it's at 15. So then you missed out at $4, right? So that's the danger of a covered call, is if we, in up markets, covered calls typically don't perform very well, because you are basically you're selling the upside, you're selling the future. In a downwards market or sideways market, then you usually keep those premiums. So that's kind of the, I guess, explanation of what a covered call is. But now let's look at how have they done versus, say, a non-covered call version. So what I'm going to show you is a performance chart of an ETF that was launched in 2011. It's a very basic ETF, has about, the same holdings as the covered call version. So basically there's one version that's a non-covered call, one is covered call. They invest in the exact same stocks. This is the return of the non-covered call. So over, the last 14, 13 years, doing pretty good, 236% up. Great. So how did the covered call version do? And it might be surprising to people. Much not as good on the total return. So at the end of the day, if you just kept reinvesting all your money and until now, you were left with about 70% less money than you would have if you just invested in non-covered call. So I think this is an interesting phenomenon, but it makes sense. The covered call was selling future upside for money today. And in a market that's generally going up, basically what that means is you're not going to do as well at the end of the day as a version that doesn't have it. So that's kind of why we bring it up, because I would say a lot of people don't realize what they're giving up to get maybe that little bit of income today. So that's just, yeah, that's a mistake we see quite a bit, is maybe being in the wrong product based on your own goals.
Now, the one thing that was kind of popping up in my brain is when I'm thinking about stocks that have high yields, I want to make sure that dividend's sustainable, right? We're going to go look to see if they've had their dividend, if they've maintained it for a long period of time. Maybe there's been increases. They've been adding to the dividend over a long period of time. How would you do that research on an ETF? Am I just simply going to be looking at the fund facts, going to the fund's website? Kind of what would be how would I find how sustainable that ETF's dividend is?
Kind of like what I was saying there before in terms of going to the website, looking at those tax factors. They're called the annual tax factors, I believe. And you'll go to the distribution section of the website, and then it'll show you how much of it was return of capital, how much of it was actually dividends, how much of it was capital gains, other income, that kind of stuff. And if you're seeing a lot of return of capital, that could mean eventually, like if they just keep giving you your money back, like eventually that might not be sustainable, right? If it's dividends, if it's capital gains, well, that's actually money coming from the company and from the underlying holdings. So that'd be a little bit more sustainable.
All right, so we're gonna have to leave it there, Chad. Now it seems that being aware of these ETF mistakes and the ways to avoid them is key to investing success. Now, do you have any final thoughts to share with the audience?
Again, ask questions, always be curious. Use these beautiful resources that TD and folks like yourself are putting up. Like, definitely use these, share with friends, and yeah, just keep. I would say just being curious, and I think that's the best piece of advice in terms of investing is asking questions. So.
All right, thanks again for joining us. And for those in our audience, make sure to check out our full lineup of educational content. We have instructional videos, interactive master classes, and of course, more live webinars. Register now to continue your learning journey. Until then, we'll see you all next time. Have more questions? Check out the links to the right and in the description below.